Hi everybody, and thanks for taking a few short minutes to listen to this video I just quickly wanted to put out around residential property and the equity markets. I'm receiving a lot of questions from clients around what we're seeing and what insight we're getting into residential property and also how that's impacting the equity markets. Both asset classes are holding up extremely well in a, let's call it, post-COVID world. But what's on the tip of everyone's tongue right now is how hot the property market is. Now, really what we're seeing in Adelaide specifically is a huge influx of demand and a very low level of supply. The numbers I've seen are about 40,000 people are relocating back to Adelaide or back to South Australia from the East Coast. People trying to escape the big cities and getting back to Adelaide, perhaps where they're originally from, or even just relocating to what we're classed as it's a regional city. Now, this huge influx of demand is pushing prices up anywhere between 10 and 30%. And unfortunately, pushing a lot of people from Adelaide out of the market because we don't have the salaries or the income to support the level of debt that perhaps the East Coast are bringing with them, or the capacity and the salaries they have which they bring with them. For example, someone who's been living in New South Wales or living in Sydney specifically for the last, let's say, 10 or 15 years. They've been working their way up through a business or through an executive role, and they come back having sold a property for $2.5 or $3 million, which is quite normal in Sydney. Now they come back to Adelaide and quite comfortably can purchase a property between $1.5 to $2.5 million, and they still have change left over for further investment. Now this is pushing property prices up and pushing out people from Adelaide who haven't come prepared with those sort of levels of cash funds. Now, great if you're an existing property owner and you're looking to sell, because you can really capitalize on what we're seeing as being a one-off at the moment level of growth. But what I'm seeing people getting caught up in is where they're selling their property with nowhere to go, trying to capitalize on the growth and no property to move into. And what you end up there with is selling a property at a high, which is fantastic, but then having the requirement to buy at the same level. So really you haven't had a great deal of gain. From my personal opinion and my personal view is that I feel that this supply and demand has to ease. There's not going to be this continual influx of people relocating back to South Australia. So the demand will drop off. Now, yes, we can certainly look at it and say money is cheap. People securing home loans at sub 2%, which is incredibly cheap. Money is cheap, and with relaxed lending requirements from banks having come in recently, the capacity to get funding approved is easier than ever before. So combine all these things, you're having a perfect scenario for this huge influx. And we're talking about property prices that were $850,000 selling for over $1 million. One that I heard was a property in Medindi that was on the market for 1.9 and sold for 2.9 and still requiring work on the building. So what does that mean for the equity markets? Well, there's still a huge amount of opportunity in that space, and the yields are really quite attractive as well. So for people that are buying properties to rent out, if you're buying them at a higher value, typically the yields are going to be lower as well. Now, yes, the argument is there that rents are higher at the moment as well. Again, but these have 12-month contracts. Not everyone is going to renew them. People may begin moving back to their bigger cities or overseas if they've been on secondment. So you can't guarantee that higher rent for outside of that 12-month period. So we're still seeing a huge amount of interest in the equity market, and it's holding up really, really strongly. It's at around the 6,800, 6,900 level at the moment. So all in all, people are comfortable holding both asset classes. But whilst money's cheap, we're seeing the huge demand for property, and that's grabbing a lot of the attention. But I draw the interest to people that already have a home, already have a property, and the opportunity there to expand your asset base by starting a portfolio. Because now, thanks to the sales around you, the property value has probably gone up. Now what that means is there's equity available in the property, which could potentially be drawn down upon to start a tax deductible or tax effective investment portfolio. Now we don't want to go too deep down the rabbit hole right now. But the purpose of this was to say, I guess, three main points. One, absolutely, we are seeing a huge jump in residential property sale values through South Australia, through Adelaide, through regional cities like northern New South Wales, the Sunshine Coast, the Gold Coast. people going for lifestyle or moving back home having spent time in typically Sydney's and Melbourne's. What we're also seeing though is the relaxed lending and the low rates, making it really, really easy to get money. But also, unfortunately, we're seeing banks lend at really high LVRs. So that's your loan to value ratio, 90-95%. Fantastic now to get you in the market. The concern is though, however, when rates go up, which they will, that will squeeze a lot of people back out because affordability won't be there. And thirdly, the opportunity then for either surplus cash that is either accruing through the sale of a property and it being retained in a bank account, basically achieving zero because of how low interest rates are. The opportunity to commence a portfolio, start a nice diversified Aussie fixed interest, internationally exposed portfolio, getting capital growth and income moving forward whilst also still having liquidity. And that's a huge advantage of having an equities based portfolio, is that you've got liquidity there, you can access the monies when you need. So in a nutshell, yes, property is hot, 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 and it will continue to do so for a little while yet. I think it'll be interesting to see what happens in 6 to 9 months' time as properties start to reduce coming onto the market, the turnover has died off, and things begin to normalise. I certainly feel that once travel opens up and people are free to roam around the country a lot easier, and most definitely back overseas, that people also even relocate back to places like Singapore and Hong Kong, the UK, US, where they may have been on secondment for a few years, but they've come back home thinking they'll relocate here. Some of those people will be required to return home. So property is hot, yes, yes, yes. Will it die off? I believe it will. But when I say it dies off, my feeling is this: if values were here, they've run really high, but I feel they're going to come off as supply and demand normalizes. Will it come back to its traditional levels? Well, that's the great unknown. So if you're looking at property, be prepared. There's a lot of competition out there. It's pushing values and sale values really, really high. But also, if you're thinking about utilizing some cash or term deposit monies that you've got sitting there, starting a portfolio right now is a really good time to begin. So if you have any questions or any concerns, please do just reach out to me, flick me an email or a phone call, and happy to help with any of these issues.